This week on the Brisbane Property Podcast, we're joined by Stacey May and our team, and we're going to share some secrets.
Stacey, share with our audience just how we're going to unpack some of the property numbers.
We talk about how the numbers can provide some clarity for clients in their personal circumstances around investing.
Welcome to the Brisbane Property Podcast with your hosts Melinda and Scott Jennison.
Hi everyone, and welcome to another episode of the Brisbane Property Podcast with Scott and Melinda Jennison, and Stacey from our team's joined us. Welcome, Stacey.
Thank you.
We are excited to be sharing some insights with you in relation to how to assess numbers before you go out and find an investment property, because in our opinion, property investing should always start with the numbers. And we've brought Stacey May from our team into this episode because as one of our property strategists here at Streamline Property Buyers and holding the qualification of being a QPIA, that's a qualified property investment advisor, certified through the Property Investment Professionals of Australia, Stacey is also able to guide a lot of our clients through the decision-making process in terms of what asset best suits their needs based on the numbers. So we're really excited to share with you some of the insights that we use to assess what makes the right asset match the person's individual unique circumstances.
Now, obviously, when we're looking at property, and we've got a combination here at Streamline where we're fortunate to, or our clients are fortunate, I think, when they work with us to have several qualified property investment advisors in the team. Myself as a licensed builder, so having that combination and that local knowledge when we look at properties, it obviously adds, it covers all bases basically. What's interesting is I think when a lot of people inquire, and most people out there do inquire about property or think about property, straight away they say, oh, I want to buy a house and I want to buy it in this location, and that's away they go. They start to shop from that without really knowing the nuts and bolts in behind it all. So we keep coming back to the numbers. And I think this episode is, I think we'll share some secrets here. So for our listeners, I think we're going to share some information that I believe is super, super valuable when it comes to investing into property.
Yeah. And I think in those initial discovery calls that we have with people looking to use our services, there is a lot of people coming saying, I really like these suburbs and these suburbs because I might know them or I've heard about them. But we start to break it down in terms of what are you looking to achieve for yourself and break that down through the numbers.
And so when we discuss the numbers, Stacey, just to help our listeners understand what are we talking about, why do the numbers matter? Obviously, we've got an investor that comes through to us. They might have certain goals in place. Why do we start with the numbers and not just, look at the budget and say, let's go and, search in this location? Why do the numbers actually matter?
I think we always say that investing comes down to the numbers. So understanding what that end goal is, understanding different things that need to maneuver within timeframes, things like that, people's what they're comfortable with as well. So working that back and customizing it to everyone's personal circumstances. We really, truly don't believe in a one-size-fits-all approach, and that's so important when everyone is looking to invest in property.
Yeah, I couldn't agree more that the one-size-fits-all, it just doesn't stack up. It's individual. It's your risk appetite. It's your requirements. You might have some requirements from your mortgage broker, for example, on yield requirements, things like that. But it's also, as you touched on, the comfort and the lifestyle that people want to live. Everyone, yes, people want to invest into property and they want to improve their wealth for future and things like that as well, but they also want to live life. So they want to be able to have family holidays, barbecues, trips away, whatever they want to do, and live life. So it's understanding what you can actually afford, not so much the asset at the beginning, but what you can afford for your own personal circumstances.
It's a really good point. And if I can also add that, many of the hundreds of clients that we've represented over the last 7 years have all come to us with very different requirements. So, for example, we've helped everyone from first-time investors who might be single individuals with incomes less than $100,000 per annum, and they have at least 30 years ahead of them in terms of that investment time frame. But, they also need to ensure that they can hold that asset comfortably given the incomes that they're on. We've also helped very high net worth individuals where income is actually not the concern for them whatsoever. And it's actually more for them about ensuring that we're building a portfolio in a tax effective way, because they don't need more income, but they absolutely are looking for the creation of wealth, and they're looking for that long-term capital growth. So this is why the numbers matter, because in my opinion, every individual will have a set of circumstances that will be unique to them. Certainly someone that might be on $80,000 or $90,000 per annum as a single individual, an investment strategy designed specifically for that person might look very different to an investment strategy that's designed for a professional couple with no dependents who are earning in excess of $600,000 or $700,000 per annum together. So this is why it's important to understand the numbers that align with the individual, and that's obviously something that we take very seriously as qualified property investment advisors.
Stacey, I'm going to throw something out towards you now. We talked. I mentioned at the start about we'll share some secrets with our listeners. Now, not everyone. I hate doing spreadsheets. Okay, so I'm not an Excel spreadsheet person at all. I get confused with them, and they're just not my cup of tea. Some people love that, and some people will understand that side of things. When we talk about an individual brief or an individual client looking to work with us, we use some software here at Streamline Property Buyers. Can you talk us through some of and give us a bit of a rundown or a bit of an understanding? Now, just for our listeners, before we do this, if this is something that you're interested in, feel free to reach out to Streamline Property Buyers, and you can book in for a discovery call. We can talk you through this a little bit more and help you understand this in depth a little bit more. This is something that when people actually see this and experience this, they go, wow, it's an aha moment of, I wish I knew that, or I didn't understand that at all. And I think you can spreadsheet as much as you like, but I don't think you can ever copy something like this. So can you talk us through a little bit of this the software that you guys use? And this is by qualified property investment advisors, obviously, so that you can help our listeners understand it a little bit more.
Yeah, look, I think a baseline snapshot of the software that we use, it allows us to input certain parameters around everyone's circumstances. So looking at a purchase price, looking at how we're going to, or how their mortgage broker has set up the loan structure, what different options might look like around that, as well as, I guess, from our local knowledge, implementing all of those types of things in there in terms of rental yield requirements, all of those types of things as well.
And you've raised an interesting point there. So a lot of people might be thinking, oh, well, this is what our mortgage broker provides for us. They'll give us an indication of our borrowing capacity based on the numbers. And I can guarantee that what we do is quite different to what a mortgage broker would provide. So yes, Stacey, you've outlined the fact that we will input purchase prices. So that's an estimated purchase price. If it's not yet a property that has been purchased, we can use an actual purchase price, obviously, once we've secured an asset for a client. But not only the purchase price, also the costs associated with that purchase. So obviously there's stamp duty, a significant cost, transfer fees, building and pest inspection fees. You've got conveyancing. You've also potentially got a buyer's agent fee. Really understanding where those costs sit and how that will influence the total cash input or equity loan that you might need to support the purchase cost. That's important up front. In terms of the expenses associated with holding an asset, it's very unusual for the mortgage brokers to include calculations that incorporate holding costs. And they may include things such as property management fees, letting fees, which is usually 1 week's rent. You might have maintenance in there. We certainly do. Also, the cost of holding an asset, which will include rates, water, those sorts of things. So being able to really capture all of those costs so that an investor has confidence, not just in the purchase price, but the cash flow position.
Yeah.
And the cash flow position on a property can really determine whether it's an affordable property to hold or not. Because at the end of the day, if you're not comfortable with how much a property is going to cost to hold, especially in an environment like today where we are in an environment where higher interest rates are occurring. A lot of properties were cash flow positive during the post-COVID boom when interest rates were at almost nothing. Some people were getting interest rates with 1 in front, which is just unheard of today. So it's important for investors to understand the numbers that apply to them so they can feel informed and feel that comfort before they make a decision to buy.
So obviously, if you sort of not summarize it, but dumb it down a bit, I suppose, for our listeners. Some people obviously, that makes a little bit of sense. But so you can basically put the number in of what you think your purchase price will be, your rent might be, and this is where we talk about the numbers again at the start. So when we're setting our brief or setting our strategy, if you want to put it that way, we can actually say, well, if this is your purchase price and this is the amount of rent you'll actually achieve, this will be your holding cost, and it'll show you that number at the bottom of it, what it is. It can then actually help you make that decision on what the type of property is and the location. Because then, as you said, Stacey, as locals, we'll be able to say that price point is these locations, and this is the amount rent you'll get. So it'll match the type of the numbers we're talking about. Mm-hmm. It's removing even more emotion out of it. And that's what investing is about as well.
Yeah. And making sure that our clients are completely comfortable with the scenario before we're going into those high pressure situations where we're already into negotiations as well.
Yeah, it's a good point. Being able to stretch test those numbers to say if we actually, had to move to a price point of this amount based on the competition in the market, or based on, the fact that there's 20, potential buyers that have turned up to the first inspection for this particular home, how is that going to look from a comfort level? Because it's much harder for us to control the price that you need to pay in a market where there's very strong demand, where properties are selling with multiple registered bidders at auction or multiple offers. I mean, you cannot control price in a situation like that. Terms do matter, yes, and we've spoken about that so much on this podcast in past episodes, but ultimately price is usually the driver for a lot of sellers. So if you're not prepared to pay a price that's close to or exceeding other buyers, you're probably likely to miss out. I'll also add that some of you as listeners might be thinking, well, we could spreadsheet all of this. It's actually not too hard. I think one of the big benefits of the software that we use, and I think this is important for anyone to build into their own spreadsheets if they are using spreadsheets, is what is the tax position? So many people I know, so many social media videos that I see from others in the market assisting investors to get into the market fail to consider the tax position of that investor. Now, if I go back to the scenarios I was talking about previously, if you have someone on $80,000 or $90,000 as a single individual purchasing in their own name versus someone that might be on the top marginal tax bracket earning in excess of $250,000 as an individual, even if they're buying with a partner and there's two people in that top marginal tax bracket, the tax implications of what they actually buy could look very different if they are purchasing in their own name. I'm also going to go on to say that the tax implications of purchasing within an entity will vary considerably as well. And it's so important for investors to understand those considerations up front. Now, of course, Stacey, do we give advice on tax?
Absolutely not.
No, we don't. But we have the ability through our software to be able to help buyers understand the conversations they need to have with their accountants.
Yeah. And I think as well, when we're looking at all of these different scenarios, another thing that I'll add to it is just because you're pre-approved to a certain level does not mean that that's where your comfort level sits. And that's really important for our clients as well.
Yeah.
Just back on, Melinda, when you were talking about setting budgets, etc. Now for our listeners, we've actually used this software personally as well. And I'll give you an example of a property that we purchased a little while ago. It was going to auction. So what we actually did is we can throw the numbers in of, if we can get a bargain, for example, and there's not too many of them around.
Everybody wants a bargain as a buyer, and even we want a bargain when we're buyers in the market. Of course, we want to buy.
So we can use the software to put that bargain number in, if you want to call it that. We know how much sort of rent you'll achieve on the property, and then we can actually increase it to go up to the next stage or the next stage, or we stretch ourselves to go, that's our limit. And at the end of, I mean, as I said earlier, you can actually see your holding costs on a weekly basis. So we knew where we were going to sit before we even, and we were so prepared, again, remove more emotion. And this was a property we're buying ourselves, where we could look at it and just say, that's what it's going to be our holding cost, or that's going to be our holding cost. So when you go to that auction, you know where you're going to sit. So it can also help people say, you know what, if it goes above that, it's stretching me too much. I'm not interested. I'll walk away until I find something else as well. I think that sort of comfort is really, really valuable as well.
Yeah, definitely. And I saw those projections coming through, and we had big conversations about where the comfort level sat.
We sought advice from Stacey because, you know, sometimes when you're too close to the transaction, it's actually good to get input from someone that does not have that emotional connection. So as you've just found out, Scott and I will even get someone within our team to cross-check our numbers before we actually commit to a purchase. And I think that's a powerful message here, having that expert input from someone that's not emotionally connected to the purchase can make a real difference.
I'll give another example, and this is very, very common. I see this a lot when you might have couples buying a property, and one person might have a higher risk appetite than the other, and we're probably similar. I'm probably a little bit more, oh yeah, look, we can afford that. Let's just buy that. Melinda's a little bit more, hang on, no, let's look at the numbers. And I think having this can actually almost eliminate those
provides the clarity,
not arguments, but disagreements between people, where you can actually have that clarity to say, yeah, look, okay, I agree, that's the numbers. Again, it's all about the numbers, and we're removing more and more emotion out of the purchase of a property as well.
That particular property was going to auction, so we were able to allow you both to have those conversations and allow time to make sure that you're completely comfortable with where it ended.
And that's just one example. I mean, these are the sorts of conversations that we can have with our clients as well. And I think if you are a property buyer, having the confidence to be able to stretch test your numbers by ensuring you get access, you either build a really good spreadsheet or you're working with a team that can help you understand the numbers. It can be life-changing. It can really help you to be more informed, more confident, and gain the clarity that you might be seeking to go ahead and either bid or put forward your offer without that uncertainty that often exists in the market.
Stacey, I'll just ask another one. When I know we've talked about holding costs, we've talked about purchase prices, rent. Melinda mentioned a fair bit about tax and that sort of things. What about if somebody's looking to, let's say we've got someone that's saying, oh, look, I want to build a portfolio. I'd like to purchase another property in X amount of years, 5, 10 years, whatever it may be. Projections forward and things like that. The software obviously does all of that as well.
Yeah, so we generally work on a single property inside these projections. So really understanding what that particular property is sitting within the portfolio for, and then we can project for depending on the timelines and timeframes that we're looking to achieve for this particular purchase. Clients all come to us with different timeframes that they're investing for as well. So we can potentially project 5, 10, 15 years to see where the asset might be able to sit, relying on the data and looking forward and looking back and things like that as well for them.
I think that's a really powerful feature within the program that we use as well, being able to actually set a strategy based on what you're hoping to achieve, not today, but within your investment time frame is absolutely critical. So yes, we can look at past performance to determine what is this past performance likely to continue in the future. And of course, no one's got a crystal ball. No one can guarantee future performance, but having some clarity to say, if we actually achieve the same results as this location has achieved in the past, what is that going to look like for me 20 years from now, or 10 or 30 years, whatever my investment time frame will be. But let's also stretch test this. What if we don't quite hit the mark? You know, what if performance is actually not as good in the future compared to the past? What does that look like for me? And am I still comfortable with that as a decision? But also, what if we outperform? What if the market improves? And I feel that we can also stretch test growth and yield comparison. So people that are looking for more growth, we can actually say, well, growth often comes at the compromise of yield. So the holding costs are typically lower in the early days. Now, what we've discovered through many strategy sessions with clients is that a lot of those growth assets, because of that equity position, there's obviously tax benefits to people to hold that asset through negative gearing under the current legislation. But people that are on very high incomes, are less concerned about holding costs. However, people that are on lower incomes, that's going to be something that's more of a concern for them. So this all comes back to personalising the strategy for the individual, because it's certainly not a one-size-fits-all approach.
I can see, I mean, obviously our listeners can understand this software matches anyone. So it's not, as you said so many times, and we talk about this, is that investing is not a one size fits all. It's not just, well, that's what you should purchase. This software really, you can adapt it or use it, I should say, for anyone at all. So any circumstance, as Melinda said, whether it's a first home purchase, whether it's someone that's a high income and they're building portfolios, that type of thing, this software can be adapted or used to match any sort of circumstances at all. And it just gives people that comfort to know, as you said, tax purposes, borrowing requirements, lending requirements, and even holding costs and things like that as well. And then obviously the projections forward to show you what equity you've got. Early on in your journey in investing in property, the first investment can make or break people. And I think having this sort of behind you gives you an understanding and that comfort to go, you know what, that is the right sort of asset we're looking for as well.
Stacey, just talk us through how we can also help our clients to get clarity and why understanding the different types of loan structures is important. Now, just for context, we are not mortgage brokers, and nor do we give or provide any mortgage advice. However, as qualified property investment advisors, through the use of the software that we use, we can help people to understand how different structures, that is the way they're structuring their finance, can influence their gearing position from a tax perspective and their cash flow position from a holding cost perspective. Just talk us through how we can look at that information to educate our clients so they know what questions to ask their mortgage brokers.
Yeah, look, I think it all comes back to educating our clients around the right questions to ask to make informed decisions for what they're personally trying to achieve, and looking at their personal circumstances, what they're trying to achieve, really comes back to mortgage structure and what we can model for them in this software. And I think we had a client recently who was a bit confused about the two options that had been presented to him from his mortgage broker, but we could model both and look at what he was trying to achieve and have those conversations together around what he most felt comfortable with.
And just for further context there, the two models that he was unsure of in terms of what would best suit him was an interest-only model where he took out a loan and the interest was the only cost associated with holding that loan for 5 years before converting to principal and interest. But the other option was straight out a 30-year principal and interest loan. Now, of course, when you can project and see how does that impact on the numbers, that enables someone to make a more informed decision about what they're more comfortable with. There's definitely investors that might have lower risk appetites that feel more comfortable paying down the debt from day one, but there's others that might actually prefer to preserve the cash, even using some offset account facilities. If they're disciplined borrowers, that's another feature that's available. So we can talk through so many different scenarios without actually giving advice around mortgage, but more to educate so that they know to go back to their mortgage broker to seek the advice that they might be seeking to get the clarity that they need to actually move forward with a decision. And that's something that I think is really powerful for people, because it also applies to people that are a bit unsure as to whether they should be putting cash into their investment purchase, or should they use an equity loan by using equity from their home. And we can model out what it all looks like through the numbers. And then if they do still have a personal mortgage on their own home, we can discuss ways that or conversations that they can have with their mortgage broker on ways to make sure that's more tax effective in terms of the way they set up that borrowing. Again, we don't give the advice, but we help people to educate them on what questions to ask so they can seek the advice from their accountant or their mortgage broker before coming back to implement the search. And I think a lot of people are surprised when they come on board with us, because quite often we won't just say, right, let's go and start searching for a property. We spend time to really educate and ensure that our clients' best interests are at the forefront to ensure their structure is correct based on what they're trying to achieve long term. And that's game changing for people. Certainly 10, 20 years from now, it can be game changing.
I was going to say, when we can project forward that 10, 15 years and have a look at sometimes what can happen if that finance structure isn't set up correctly, the headaches that can create for some people as well, because they're just thinking about the now as opposed to projecting forward.
You've both taken what I was about to say, I think, talking about, making an investment. Don't rush in and do it straight away. Take your time, get some advice. As Melinda just mentioned, the information, the questions, we won't give that financial advice, but we can work with, as a team, work with your accountant, work with your mortgage broker, so that everything is set up, whether it's your entity, whether it's how you're borrowing your money, how you want to set things up, because once it's done, it's too late.
That's right.
Because if you go and purchase a property, it's done. You've already set up, you've already purchased it. Whereas if you actually get it organised at the beginning, it does set you up for that path for what you want to do and what your individual your goals are personally.
And I think as well, in saying this, what we do is set all of this up for our clients at the very start and then adjust it for each and every property that we're considering throughout that search phase. And that becomes so important when we're looking at those different yields and things like that for that particular property at the time.
Yeah, it's game changing. It gives clients so much confidence if they, they're not just looking at pictures or a video that we might have done or something that's presented to them online. It's actually about the numbers when it comes to property investing and seeking clarity and seeing reports that are purely number-based reports on how this asset is going to perform. From a cash flow position from the day of purchase, but also looking at various scenarios of what could happen in the future if all of these situations unfolded. I think it can be, confidence building, but also it's set up to mitigate risk. And I think that's a really critical piece in property investing. You don't want to go into a situation where you're exposing yourself to risk, because that can cause a lot of financial loss in the future.
I think there's a big difference between buying property and owning property and investing,
absolutely,
smart investing into property. And when you do it right, there is a big difference, and you can actually see that. Again, as I said, take the emotion out, look at the numbers, and then you look at the asset to match the numbers for what you're trying to achieve.
Yeah, I think the other big thing, I know you mentioned before, first-time investors, and when they maybe have a 10, 20, 30-year time frame in front of them, we can really give them the confidence to stick to that strategy long term, because we can project forward and look at the equity position, showing them what holding high-quality assets within a portfolio can really do for them over time.
It's interesting because there's a lot of talk in the market at the moment about, property should be transacted like shares. You should be getting into markets, and after they've, shown rapid growth in a couple of years, get out of those markets. People, I think, quite often forget that that type of strategy is an income-producing strategy. It's going to trigger capital gains tax. There's huge costs to buy through stamp duty and other costs. There's also big costs to sell, selling agent fees. A lot of those profits can be simply eroded. And a strategy of getting in and getting out, if someone's doing that in their own name and they're on the highest marginal tax bracket, it's just a really ineffective way to build wealth. And so this is why it's so important to understand what is the individual trying to achieve, what are their goals, what time frame are they working with, because for us sometimes people don't know what they don't know, so it really is up to us to help them understand the gaps and then point them in the right direction to seek the knowledge. I mean, we've had people come to us that want to develop property, and they're keen to do it, and they're purchasing in their own name. It's like, if you sought advice around structure, because the risk associated with being a property developer is a lot higher, perhaps you need a conversation with your accountant to get the advice around risk before you actually proceed with the purchase. And I think the point is, a lot of people don't know what they don't know. And so seeking advice from professionals can often prevent a lot of risk in the future, but also save a lot of money long term.
Now, I know when you go through this at the start, you talk about different phases of investing, so accumulating, and can you just explain that a little bit more, because that obviously then helps with us when you're tailoring a specific purchase or investment for a client as well?
Yeah, so every client is in a different phase of building their portfolio, and we break that down into 3 phases: the accumulation phase, the consolidation phase, and then the income or the retirement phase. And typically in that accumulation phase, it's about accumulating high growth assets to contribute to your portfolio. A lot of people may also own their home and be paying off their personal debt during that phase. Consolidation moves into the phase where you do need to actually repay debt back to the bank. So you have the ability to consolidate the portfolio. Now, for some people, that involves divesting, that's selling off some assets to pay off the debt of others. For others, it's switching a lot of those properties into faster repayments so that you produce at the end of the time period when you're moving into retirement an income producing portfolio. Now, again, a lot of people will convert their portfolios in that consolidation phase. They might actually sell off some residential properties, realize the capital gain, especially if they are in the early retirement years, but they'll also potentially redirect those funds into either more liquid assets or commercial property, which is much higher yielding. So this is where getting strategic advice really matters, because what one person can achieve based on their personal circumstances might be very different compared to what another person might achieve. So hopefully that gives a broad overview of the different type of investors and strategies that exist.
And the reason I did throw to that as well was back to the software. You can put the numbers in and you can actually see what that looks like when we're talking about numbers.
That's right.
So I know that, and you can use it for residential. We use this for residential and commercial.
Yeah.
So we help clients with residential and commercial properties. And we can, again, we're talking about the numbers. We're not talking about so much the asset.
That's
but
right.
the numbers, then you can actually look at that and say, yeah, look, that matches my phase or where I'm up to. Again, we're back to the individual again as well.
Yeah. And also back to the asset selection as well, because commercial and units have two very different kind of data points that we need to make sure that we're allowing for in there as well.
Absolutely.
Perfect.
Lots of
I think we've
info
shared.
to
I think
unpack.
we've shared some secrets there. Hopefully, that was good information. If it doesn't make a lot of sense, or if you want to know a lot more about it, as I said at the beginning, feel free to reach out, book in a discovery call with the team at Streamline Property Buyers. We can have a chat. We can talk you through it and give you some more information to hopefully help out and change things for you. So thank you, Stacey, for joining us for a chat today.
Thank you so much.
Yeah, thanks for sharing all of your knowledge with the team or rather with the audience. Appreciate it.
Thank you.
As always, we hope you have enjoyed this podcast episode. If you have, please share with friends or family. If you know someone that's considering getting into property investing, perhaps ask them to listen to this first so that they can understand what numbers might apply to them as a first step. Also, we would love for you to subscribe, hit the subscribe button on whatever podcast player you are tuning into today. As always, we hope you enjoyed this episode. We look forward to speaking with you again next week. Bye for now.